One story, actually, just from a client of ours, I do remember going into their house. This is before COVID when we still used to meet people in person. Now everybody's on Zoom. He said, I love it when Laurent and Rob come over because I never lose money. He liked to invest in a lot of different things. Some of them could be called schemes. When we came in, he's like, I love when you guys come because these whole life policies that I bought 10 years ago or however long ago, they just keep chugging along. Yeah, they're not doing anything spectacular, but they don't go down. And they never say zero, and they never say negative, which is great.
That is good because it's the only product that allowed to smooth the returns.
Yeah.
And average out the returns over the years. So
when it's vested immediately.
Yeah.
Right.
Well, when you receive the dividends vested, but inside the fund, they can take the great years and save them for bad years. So the dividend is smooth, which is a really good mechanism to have in insurance. That brings about a different conversation about the sequence of returns is more important than the average return.
Yeah.
And so with whole life, the sequence of returns is actually smooth. That helps you a lot better than just negative returns once in a while.
100%. Yeah. And actually, and when you're looking online, I find a lot of people just talk about average returns, right? Whenever you're reading anything financial online, the solution to everything is always an S&P ETF low fee because it's a 9% average return over time. But what that doesn't say is that, 1 year it was 25 up and the other year it was 30 down.
Yes.
And then the next year it was 15 up and then the other year it was 40 down. And you're like, well, if you're catching it on a good year, that's great. If you're catching it on a bad year, that's not great. But technically over time, it adds up to 9. Your sequence of returns there is way more important than the average.
Absolutely. And not only the sequence of returns, but you must remember that life insurance costs money.
Yeah.
So where does the insurance company take the money to pay for your cost of insurance? It comes from the investment that you have inside the policy. So the worst time to take money out of an investment is when it's going down.
Right.
So if the market's going down and you haven't got smooth returns and they're taking the cost of insurance out, if you start at $1 and you lose 7%, you're down to 93 cents. If they take a nickel out to pay for your insurance, you're down to below 88. It takes a lot more than 7% to get back to $1.
Right.
So that mechanism over and over and over again of pluses and minuses can affect your overall performance of the policy in a great way.